All right, welcome to a new trading week. Let's bring in our good friend Mike O'Rourke. He's Chief Market Strategist at JonesTrading for a little bit more on the Wall Street buzz. Mike, I guess I'll start with the debt ceiling story. It's been a bit quiet to start the trading week, but people still trying to figure out what's going to happen in Washington. How much of the market movement right now do you think is tied to that?
I do think a little bit is tied to it. I don't think it really should be at this point. We're still at the very early stages of these negotiations. And I know, obviously, there's been a meeting scheduled for tomorrow, but that's just more about logistics of, Biden's supposed to travel to Japan for the G7 on Wednesday. So obviously, if you're going to get a meeting in and it wasn't scheduled for today, it would be tomorrow. So I don't think, I don't think we're going to see a whole lot out of this meeting. But, obviously, we'll have to see what happens.
Okay. And then I guess for how it pairs with the economic story right now, are you bullish or bearish on equities for the rest of the year?
Right. Yeah, as you know, I'm bearish, John. I think we have a lot of risks out there. And even though I believe we have this Fed pause and tightening that's going on right now, I think we're in this new environment where you just have this higher for longer interest rate environment. I think that's going to persist well into 2024. And we're starting to see the effects of tightening take place. Even in the data we just saw at the end of last week, you saw that uptick in initial jobs claims here in the U.S. That was an 18-month high. And when that starts moving, it usually unfolds pretty quickly. And then, we had the May preliminary Michigan sentiment on Friday, which is the first May, look we have at a May number, and that was pretty soft, but also the inflation expectations uptick. So that's a little concerning.
And how is it going to impact if you're already feeling skeptical, where you would essentially avoid being exposed and where you might lean in as an investor?
Well, I definitely would be cautious, and I think it's just going to be a challenging environment for the next 6 months or so, as the situation plays out. I do like the banks after the correction they've had, and I call it whether it's a regional banking crisis or a mini banking crisis. I still think that group obviously has had a significant correction and has taken, priced in a lot of risk. So I think that's advantageously positioned as other groups start to correct in prices.
Also want to talk about the banks, which have come up in the Canadian context today on our program already, just because they're about to report their quarterly results. But our first strategist this hour was more optimistic on that group because they had seen so much weakness, just given some of the banking turmoil. And I know even though you have been fairly skeptical for a while, coming into this year, you were looking at the banks. We had the banking uncertainty. There's still uncertainty today, but has it opened the door, in your opinion, to maybe taking a fresh look at some of those financials?
Oh no, I like the banks. I still think they're attractive. Obviously, especially the big banks here in the United States. Basically, what's happened with the regional banks that have had challenges here or issues, and the ones that failed specifically, is when you had the Federal Reserve and U.S. federal government pump so much liquidity into the system in 2020 and 2021, you had this massive influx of deposits that they had to invest in. Those banks made some poor investments. And I think that's the problem. I think it's more specific to those banks than it is to, the larger banking system overall. And basically, the larger banking system overall has repriced or discounted a lot of risk here. There are going to be commercial real estate risks that are going to unfold in the future, but a lot of that depends on how, if, when, how a recession plays out due to the Fed's tightening. And again, right now, the economic data is not supporting that. Not saying it won't support it later this year, but we're matching 6-decade lows in unemployment in the United States. So there's still some economic momentum in this economy.
And before I let you go, given there is still some economic momentum, given that earnings season was not a disaster, which I think the most bearish people were sort of predicting there might be some very scary outlooks, What is your view on tech? Because we did a segment earlier based on some historical evidence that just because you've got a few tech names that have dominance within the S&P 500 doesn't necessarily tell us where the S&P 500 will be in a year's time. I mean, I'm going to assume you're still pretty cautious on this group, but does the sentiment get too bearish just on the idea that a few names have concentrated power within the S&P 500?
Well, I mean, that's obviously not a positive that 7 names are driving the S&P 500 gains for the year. So when you're a passive investor, index investor, obviously your returns are fine and they look good. But it speaks to the underlying weakness throughout the rest of the stock market, and whether it's the balance of the S&P 500 or even if you go even broader to the Russell 3000 or Russell, which is the 1000 and 2000, you're not seeing that same level of strength. So you don't want to have too much faith in 7 names backstopping, the entire stock market or supporting the index. And that's something investors should be concerned about. I do think, you're seeing these names. For example, Apple's earnings and revenues are going to be down year over year, but the stock's, approaching all-time highs. That's one of those things where, that's not something broad market investors should feel good about, even though for the time being, Apple shares are helping to support the S&P 500.
Right.